to share the investment approach. And then finally, it's shared economics. We're targeting $2.5 billion of equity this year, and it will be strong contributions both from PNC and from TCW and our affiliates. So that economic alignment aligns our interests with PNC and also, of course, with our clients.
So, Katie, targeting $2.5 billion, how big could this partnership get, though?
We think this partnership could expand significantly over time, and that's important because private credit managers and banks, we think those partnerships with us and others will continue because banks are under some regulatory pressure, and private credit managers, they have the capital to allocate and to lend, and banks have great origination capabilities, and those two things are going to have to cooperate so we can continue to put credit out into the U.S. market.
What does significantly mean?
I'm not going to give you the exact billions of dollars, but I will say that
double from the initial 2.5 or many times?
Actually, for our credit alternative platform broadly, we've already doubled the AUM of that platform over the next couple of years, and we're expecting it to be many multiples over that. And this is going to play a very important role in the growth of TCW's alternative credit platform.
Carol mentioned at the start that you've been busy. Another,
Yeah.
I guess, deal, if you will, was the conversion of two mutual funds to ETFs.
Yes.
In the AI space, talk a little bit about why you made that
Sure.
move.
Well, first of all, mutual funds in general, we think that they have a place, will continue to have a place in the market, very important part of our business.
It's still a big part of TCW.
Very big part of TCW, and will continue to be a relevant vehicle. It is also true that clients are looking at the exchange-traded fund vehicle because of the liquidity, the tax efficiency, and the transparency and ease of trading of those vehicles. And so we are going to convert several funds and launch new ETFs. We did one in AI. I do want to emphasize, I am a believer in generative AI. We have been managing AI strategies for 7 years. So this isn't something we just launched because ChatGPT is cool. We saw that transformative technology almost a decade ago and launched a strategy on that. We're investing in the technology enablers of AI and also the companies that will benefit
That's what I'm curious is, what is a portfolio of AI stocks these days? Because if you ask someone else that question, they would just say, well, NVIDIA, maybe Microsoft, and that's it. I assume this is broader than that.
We have some of those in there. So these companies that are driving the technology of AI, but then also the companies that are the beneficiary. And it's actively managed, and it's relatively focused. And so what we're going to do is shift the shape of the portfolio as that narrative of AI changes over time. I do just want to say one thing, because I think it's important to be balanced on these issues. I do believe in the transformative potential of AI, but it is a story that's going to play out over the very long term. And so a vehicle like this is appropriate for people who can take that long horizon. And this is said a lot, but I think it's a very good reminder. The internet was also an incredibly transformational technology, but that didn't happen in year one, in year two, and year three. It took 20 years. But if you stuck with that narrative for a couple of decades, and many of our clients have that type of durability of capital, it was one of the greatest wealth creation opportunities in the U.S. economy. And so we are excited about it, but balanced in telling people this is a great vehicle. Be active, be selective, which we are. Be with a manager that can evolve with the narrative, but also be long.
AI is such a part, as you know, of our investment narrative, just generally speaking. Take the big, broad macro, Katie. What are you seeing right now? How would you describe the environment?
I would say that we are long dispersion. The idea of dispersion across all of our portfolios. It's really hard to predict this in short increments, but what I would say to you, whether it's private credit or it's public credit, we think that the spreads, and I'm going to talk about public because it's just a little easier to point to valuations, which are at record tights in credit markets. In their post-global financial crisis history at record tights. That valuation is inconsistent with some of the obvious challenges that we have in this economy, regardless of whether or not we get a recession. Let's take the scenario where we muddle forward and have some type of soft landing, but rates we all believe will stay elevated because inflation's still pressure. That could create a credit event, right, when rates are this high. And these companies, we're already starting to see stress in certain parts of the credit market, not priced into credit spreads. So in our liquid portfolios, where we do take macro views, which is in the core plus space, remember that's people's retirement money. So we're managing that for their retirement assets over many decades. We're conservatively positioned. We're overweight agency MBS, which is carrying over the index, and we're being very patient. And eventually this is going to break. And when it does, we'll lean into those specific credit opportunities. If on the other hand, we do get the recession, then we're going to have a credit event anyway in both public or private markets, and that will create dispersion.
Are you suspicious that the default rate isn't something different than what it is today?
So this is a good point. Default rates are actually where we would expect them to be in the traditional levered loan market. They're low and actually went down in the first quarter in the private credit market. And I'm glad you asked that because we think that's really masking some serious liquidity challenges in the private credit market.
Yeah.
And the obvious question is why? Why is this happening? Well, I would ask first, why is there stress? The reason that we think there's actual stress that's not showing in default rates yet is because from 2019 to 22, these capital structures were highly levered with the view that rates would stay zero forever.
Right.
And that didn't happen, and now math's taken over, and they're under pressure. Now, why haven't the defaults gone up? My answer to you on that is that if you look at last year, the amendments of these loans were 3 to 4 times normal. And we don't generally amend loans when things are going well. So this cannot be extended forever, and eventually those default rates will rise. I'm going to end with just bring it back to dispersion. If you look at the last 15 years in the private credit world, the dispersion between the top and bottom quartile manager is about 15 basis points. This is not high dispersion. That number could 10x or more over the next couple of years as these defaults rates rise. And that's why you obviously want to be with a manager like TCW that does conservative lending, diligence, very high levels of diligence, very significant underwriting. And we feel really great about how we're going to manage this environment for our clients.
All right, Katie, we have to leave it there. Great to talk to you.
Thank you so much.
Appreciate you taking time for us. Katie Koch, and of course, leads TCW, taking time to talk with us here on the Milk and Sage.
Yeah, listen, we're looking at the markets bouncing around here. Looking like we're about 5,200. We're not going to make it here with just a few seconds of trading, but we did pop above that on the S&P 500 a little bit earlier.
We talk about sustainability of that rally here, and I think that's what a lot of folks want to see. Tim Stenovic has been keeping an eye on that. Back in New York, Tim, counting us down to the closing bells.
Yeah, just about 30 seconds to go. We're going to start hearing those bells very soon. But as you mentioned, stocks bouncing around a little bit on this Tuesday afternoon. We did hit 5,200 on the S&P 500, but we are not looking like we're going to be closing above that on the day today. Also did see later in the session the NASDAQ move lower from gains to losses just this afternoon. All right, as we wait for things to get settled on this Wednesday, it looks like the Dow Jones Industrial Average will close higher by just 0.1%. We can go ahead and round that up. The S&P 500 higher by just over 0.1%, while the NASDAQ 100, NASDAQ Composite, I should say, closing down by 0.1%. Seeing a little bit of outperformance like we did yesterday on the Russell 2000, that higher by close to 0.2%. Using the IMAP function for the S&P 500, we can see the different areas of the S&P 500 that did move higher or lower today, led by materials, utilities, and consumer staples. Materials higher by more than 1% today. Consumer discretionary rounding out the bottom, lower by 0.5 percentage point, as is information and technology. I do want to talk about a couple of the gainers and decliners on the day today, starting with Apple, among the best performers in the S&P 500 today, higher by more than 0.5 percentage point, but 0.4%. This after the company announced a larger version of the iPad Air, aiming to reinvigorate their iPad lineup. It's been a couple of years since they've gotten an update to the iPad. This is the first redesigned version of the iPad Pro since 2018. The new model, as you may guess, thinner, crisper screen, OLED technology, also got a faster M4 chip that can handle AI tasks. Also want to check in on shares of Alphabet because they were higher all day today, though they did move higher after Google rolled out a new version of its low-end Pixel smartphone. It's called the Pixel 8a, starts at $499. Comes a year after the 7A model, funny how that works, adds a faster processor, a brighter screen, also an option for double the storage and new AI features for the camera. Starting to get a theme here when it comes to new hardware from these companies. Everyone's leaning into AI. Alphabet trying to take on Apple and Samsung. Also, as far as decliners go, shares of Walt Disney falling the most in a year and a half after the company reported a not-so-great outlook for growth in streaming subscribers in the current quarter. Also said that visits to theme parks are expected to moderate from peak post-COVID levels. A reminder, Bob Iger is back, and he's in the midst right now of a years-long effort to reorganize Disney in the age of streaming, as the company does lose subscribers from its cable programs. He's been under pressure from activist investors. He's aggressively cut costs. He's propped up ESPN and pumped new life into Disney Studios after some box office misfires. Also, checking in on shares of Palantir to the downside today by the double digits, having their worst day intraday in nearly 2 years. This after the company boosted its revenue forecast for the full year Expectations were high. The stock did triple in the past year. It was up around 40% going into the report, which came after the close yesterday. Palantir's roots are in government sales. It develops software and analysis for companies and government agencies. The company's CEO, though, said demand from U.S. companies for its AI software now drives most of the business. We do have lots of, coming after the bell, we have lots of earnings. I'm going to bring those all to you live as they do come across. Carol and Romaine, back to you at the Beverly Hilton.
All right, we continue our special coverage here from the Beverly Hilton. It is the titans of private credit circle the hallways here of the Beverly Hilton. The legends of private equity, they want to remind you, they haven't gone anywhere. And if anything, they've actually graduated, Carol Masser, to the next phase of growth. At least that's the view of our next guest, who says PE has now evolved into a, quote, form of business versus just its origins as a form of finance. And that actually lays a foundation potentially for better returns through building businesses and governance rather than just leverage and risk. Stephen Klinsky co-founded Goldman's original private equity group back in the 80s before branching out on his own in the late 1990s with New Mountain Capital. Pleased to say he joins us here. Definitely a legend in the business. Great to have you here, Steve.
Thank you both for having me here.
Let's talk about this idea of the evolution of PE and the idea of a form of business, because I hear this so much. This isn't about cutting checks anymore. Maybe it never was, but it's much more now about the hand-holding, about the business building.
Yeah, you know, I'm one of the original private equity people around. As you said, I came in 1981 when the 10-year Treasury was 15.8%. There was lots of inflation, and it was about leverage in those years. 40 years later, there used to be 20 private equity firms. Now there are 5,000 private equity firms owning 30,000 companies, employing 12 million people. And the best private equity firms, you have all the advantages of being like a family business where you're close to the ground as shareholders, but all the scale of a big organization. You're not under 90-day reporting. You can get the best managers and build the businesses. So, you know, the real success is it's not where interest rates 25 basis points higher or lower. It's how you took a company from good to great. And that's what we try to do, and that's what I think other good firms try to do.
What does that take, though? Or let me rephrase that. What are the companies themselves asking for from someone like a New Mountain or any of your competitors?
Yeah, you know, we have mega fund strength, but we buy mid-market companies. So let's say it's a $500 million value business. The founder's retiring. He may never have done an acquisition, may never have gone global, may never have thought about AI, may never have thought about Salesforce construction. So we take businesses that are already safe and sound. We've never had a bankruptcy or missed an interest payment, but the key is building them up to a much, much higher level.
Never had a bankruptcy ever.
Never had a bankruptcy, never missed an interest payment. And we have now a team of 250 people at my firm and many, many more affiliated with the firm. So we can put in large sets of operators to assist the management at the company. And that's what it's about. You don't want to be good just in one interest rate environment and bad in another, or good one year and bad another year. It's all weather business building.
I love how you came out of the gate and started, because we keep saying, you know, oh my gosh, we got to go back to like zero interest rates environment. That's the abnormal part of it. You come out of the gate and say 15, 16, 17%, you know, talk to us about the constructive conversation we all need to be having about today's rate environment, what it means for the investment landscape.
Yeah, you know, look, at any given interest rate, private equity functions fine. As rates go up, things get cheaper, so it's easier to buy the new company, a little harder to sell what you bought before rates went up. So, but then it stabilizes. So when you actually go back to the early 80s when interest rates were crazy high because of stagflation, that was the best time to buy companies because they were so cheap. And my firm actually had a very active year both buying and selling last year. And I think we got some of the best things we've ever bought in the last 12 months when some other people were out of the market. So you're always buying and selling as a mature private equity fund.
Well, tell us about what you are buying or what's of interest at this point. I'm blown away that never, you know, filing a bankruptcy. So what is kind of the secret special sauce, if you will, in terms of what you look for in a company and what you are, you know, committing to?
Yeah, so what we do is we pick sectors proactively that are non-cyclical growth sectors like life science applies, healthcare, IT. So, for example, years ago, we had a business called Avantor that started at $290 million. It's now worth about $20 billion. It's second biggest to Thermo Fisher in life science supplies. So a year ago, we did a big carve-out from Perkin Elmer, where we bought all of their life science supplies businesses, their legacy crown jewels in spectrometry and chromatography, and very complicated carve out. They wanted certainty in a bad market, and I think we can add a lot of value to that company. Or we have a lot of good success with a company called Citrin Cooperman in accounting. We're in the process of buying Grant Thornton, which is one of the 7 largest accounting firms. Wonderful firm. We just bought BMI, which represents 1.4 million songwriters from Taylor Swift and everyone else. It's a business service that collects their royalties, and we think we can add a lot of technology and growth to improve it. So we're in these industries. My firm's now been around for about 24 years, so we've gotten stronger and stronger in these spaces. And we don't depend on debt, so we could just get some good buys.
Also, a common thread with a lot of those companies you mentioned is kind of the acyclical or non-cyclical nature of the businesses. So that is the core strategy.
We have 2 big ideas in my firm. We call it defensive growth. And it changes as the decades go on, but what sector can grow non-cyclically, high free cash, high barrier to entry for the next 5 to 10 years? That's where we focus. We have teams working in these sectors. And then when we find a nice, safe company, we then spend years building it to get the return. So, that's what we do.
All right. Steve, we're going to have to leave it there. Great to talk to you, and great to have his perspective here. Really one of the titans in private equity, Stephen Klinsky of New Mountain Capital here. And it really, too, I mean, we didn't get a chance to really ask him kind of about the interplay now that you're really seeing between the private markets and the public markets, which to a certain extent is intensified. I'm not sure who's more dependent on who now.
I don't know. But I just think about companies in general just have so many options in terms of their either financing or credit needs at this point, and it really gives them, I don't know, potentially, some different lifelines, if you will, in pursuing kind of different businesses. So I just think it's fascinating, the optionality that's out there.
All right, we're going to continue our conversations here from the Milken stage, and we have some breaking news going on. Tim Stenevik back in New York. Tim, take it away.
Yeah, reminder that we're still in the midst of earnings season. We got Lyft earnings crossing the bell, crossing just moments ago. Shares are surging in the after hours. I do want to start with Reddit, though, higher by more than 15%. We're seeing shares move higher because they reported revenue for the first quarter that beat the average analyst estimates. Revenue come in at $243 million versus the estimate of $211.9 million. Daily active users, a key metric here for Reddit, coming way past expectations, 82.7 million versus estimates of 77.35 million daily active users. Remember, this is the company's first report as a publicly traded company, though investors did get a good idea of the financials when it did its roadshow. I do want to move on over to Lyft. As I mentioned, Lyft surging in the after hours as well, up more than 5% right now, is up as much as 10% a little earlier. First quarter results, financial guidance beat investors' expectations. Gross bookings jumped 21% to $3.69 billion for the first 3 months of the year, surpassing analyst estimates of $3.59 billion on average. The number of active riders came in at 21.9 million. That also exceeded expectations, and it grew at the fastest pace, going all the way back to 2022. As far as that guidance look, also came in solid for the current quarter. The company does expect to post approximately $4 billion to $4.1 billion in gross bookings, just above what analysts expected. Different side of things for EA, the video game publisher, down after it forecast net bookings for the first quarter. The guidance missed the average analyst estimate. The company sees adjusted earnings per share at $7.05 to $7.85. The estimate was for $7.52. Still, investors in the after hours sending the stock lower by about 4.3%. Carolyn Romaine, back to you at the Beverly Hilton. I will stand by here and keep watching for the latest when it comes to those numbers crossing.
All right, Tim, so appreciated. Tim Stenevik back there at Bloomberg headquarters in New York City. Well, Citi CEO Jane Fraser was here at Milken. She expects the equity rally to continue. That was among her comments at Milken yesterday, appearing on a panel, a wide discussion on the market environment. Another member of her team also at Milken with us is Andy Saig. He is head of wealth management over at Citigroup, and we're delighted to have him join us.
Hey, I'm great. Terrific to be here. As you said, there's a bullish sentiment here at the conference, so it's great to hear.
Are you see that among your wealth management clients? Give us an idea of the conversations.
We see people very front-footed in terms of looking for opportunities in the markets. Obviously, what's been happening in the U.S. market has attention around the world. Our business is very global. We see a lot of discussion, of course, about the U.S. election, but honestly, I don't think it's really driving investor decision-making. They're looking through that to just the underlying fundamental strength in the U.S. economy and value they see in our equity markets, even after this run.
Andy, get into some of the specific investments at the wealth management area that clients really are interested in. You know, we talk about private credit. Here's another year at Milken. We talk a lot about private credit. AI is once again dominating the investment themes. I'm curious what those clients are asking for and what they want exposure
well, you put your finger on it. I mean, probably the number one topic, and our clients in the private bank around the world are they're real change makers in the world. They're very high net worth individuals. They've got they're investors with great acumen. So the focus on alternative investments is at the top of their list. We happen to have one of the strongest alternative investment teams in the market, and so a lot of firms here at the conference are ones that we work with clients. In the U.S. equity market, healthcare is a topic that investors are very focused on.
What specifically in healthcare? It's kind of broad.
It's very broad based, because when you think about where AI and so many other technology trends are going to have their secondary and tertiary impact, it's going to be in an area like healthcare. So I think we're entering an era of innovation in healthcare, which is going to be mind-blowing. And investors see that. They understand it. We think it's a very durable trend and a place people are putting capital to work.
We have a guest later up coming up talking about innovation in healthcare.
We'll be talking exactly about that. I do want to ask you, though, I've heard you talk in the past about getting sort of a larger sort of wallet share, if you will, out of existing clients. What gets you there?
Well, I mean, hey, with our clients, as you said, Citi's business today, it's an outstanding business, but we've got a tremendous opportunity with our clients to do more with them. And so some of that is getting to know them more deeply, trying to connect the dots in situations where we're a corporate banker or an investment banker with a family office or otherwise a wealthy family, and introduce the investment capabilities of Citi. This is a powerful and broad-based investments business. It's not just alternatives. We were talking about earlier, we have some of the industry's most sophisticated capital market solutions. We work with asset managers across the traditional space. And so a lot of this, honestly, is just ensuring that our dialogue is as broad-based as possible. We've got many clients who know us for our banking strength and our sophistication as a lender, and we're reintroducing them to what we can do in the investments.
But with regards to the wealth business, I mean, how do you sort of improve the performance? I mean, the last couple of quarters have disappointed to a certain extent, and I know that's just kind of the short term. But as you look long term here, what gives investors a more consistent return?
Well, I mean, from a shareholder perspective, I mean, this business, we've got a very strong focus on what the business model should be in wealth management. This should be a business with pre-tax margins approaching 30%, returns in the 20s, and strong organic growth. And so we're setting out in a very disciplined way to deliver that. First up, you know, this business has to be more fit. We're taking a lot of topics that honestly are hobbies, and we're sunsetting those. We're readjusting the expense base in the business, and that's something investors are going to see, you know, in this quarter. We're shifting the focus of the business, as to your earlier question around the investment solutions and investment advice we can offer to clients. Right. We can't just be our client's lender or their banker. We need to be their investment advisor. And we're elevating the quality of the experience that we offer clients around the world. Heavy investments in our digital platforms, focus on the training of our people and personnel, more discipline in terms of and intensity around how we cover clients. And we think that all adds up to a powerful proposition. And you're going to see us unify this business around the world in a way that ensures that regardless of where you're touching Citi, you have access to the best-in-class capabilities that this firm represents.
Well, there's a lot going on in wealth management, a lot of competition too out there, that's for sure.
Yes. Well, I mean, that's why the power of this brand and the strength of the client franchise, you know, our challenge is different than most. We're not out trying to acquire clients first and foremost. We're trying to do more with our existing clients.
Makes sense. Andy, thank you so much.
Great to be here.
Of course, of Citigroup. Well, folks, it is all about private credit here at Milken. Investors and bankers expect private markets to keep growing even after rapid expansion in recent years. Here's what some of our guests have said about the private credit market.
We think credit is interesting. I think as the private market has grown, it's become a very real competitor to the liquid market.
It has been an excellent time to be in the space. And that's because of, one, where base rates are. You know, spreads are good, but when the base rate is at 5.5% versus 1%, that obviously makes an enormous difference in terms of yield. And second, I would say the willingness of companies to engage in a private credit solution now compared to 5 or even 10 years ago.
It's matured, and I think that's a good thing when markets mature. There's many more participants, and so there's less, in one sense, there's less inefficiency. At Crescent, we like to invest over 33 years in things that are inefficient, but there's plenty of opportunity, in the world right now. And I think some of the stability we've seen, in the capital markets and interest rates and so forth is enhancing that.
Historically, I think people have thought of the public markets as safe and private markets maybe as riskier. When we look at the potential nature of the public markets, what we realize is that they are safe and risky at the same time that the private markets are as well. And it's really construction of the portfolio that matters.
All right, some of the great voices that we've had here on the Milken stage, and we continue those conversations right now with the focus on investment banks, which have been signaling upswings in 2 business lines that don't usually take off at the same time. Advising ambitious companies on expansions while helping others still drowning in debt. Now, those simultaneous waves of deal-making and restructurings, they've been the talk of earnings conference calls at firms like Evercore, like Moelis, as well as Lazard. Ray McGuire knows more about this space than anyone, having run Citigroup's investment banking business for more than a decade. Before that, he helped run M&A over at Morgan Stanley, as well as other banking roles at First Boston, Wassertein Perella. And for the past year, he served as the president of Lazard, the world's largest independent investment bank. Ray McGuire joins us here on the Milken stage. Great to have you here. You have a pretty long resume.
I'm with you guys. That's impressive. Big time.
Is business good right now in the investment banking world? Is it better?
We just announced first quarter record earnings in the first quarter of this year. So the answer is yes, business is good, and I say that with cautious optimism. There's still headwinds out there, but we think the tailwinds are pretty strong, and so we'll see how this evolves. And you're right to point out that we have both a restructuring business and an M&A business, which historically have not worked so much at the same time. But today we see that is a little different.
Is the economic backdrop supportive of that? Is it good or good enough?
Well, I would look about the economic backdrop is, look at it where Fed rates are today. We think that's going to be higher for longer. With the corporates, that translates into making certain that they got the right strategic profile and the right strategy. For the asset managers, which are 30 to 40% of the overall fee wallet, we're figuring out what they're going to do, right? Many of them are active. Restructuring, as you said, is an active part of the business, and we expect for both to continue.
Ray, it's fascinating to hear you say record quarter, and then you're like cautious optimism. That's kind of a span. Why? Why are you so cautious in this environment?
Because you still have some tailwinds out there. Some headwinds out there. So what most? Well, interest rates being one.
Yeah.
The interest rate, what's in front of us today are interest rates and the state of the economy. Inflation remains sticky. The Fed is looking closely at the data. That's what's in front of us that we have to manage. What's ahead of us is what's taking place geoeconomically and geopolitically. And there I'm looking at 5 different trends that we need to manage. AI is one, energy transition another, deglobalization or reshoring is another, what takes place with cybersecurity is another, and then what takes place with aging. The largest growing part of the American demographic is 65 and over. And if you look at the American story as the kind of the anchor to the global north, and then you look at the global south where the largest growing population is 30 and below. So we have to take all those factors into consideration as you think about the trends that are taking place. And I'm distinguishing between a trend and between a cycle.
That's a lot. That's certainly a full plate, right? And so I get the cautious optimism. Is it something that as we kind of deal with all of those and some of the disconnections we might see play out in the marketplace, does it ultimately lead us to some downturn at some point to kind of find our way through it? Or
I can't see downturn.
Okay.
I can't tell you that the headwinds are that strong. The tailwinds are probably a little stronger than the headwinds, but they exist. So I can't predict a downturn at all. I'm looking at where the market has traded. The S&P for the past 15 years is now traded at, one of its historic highs for the past 20, 50, 100 years at close to 14%. The dollar is the strongest it has been in 15 years. I look at that and I look at what's going to take place cross-border as an example. The North American wallet still remains the largest. Notwithstanding some of the headwinds, I think the tailwinds are pretty constructive as well.
Do you think you have a good read, though, on the economy? I was listening to the panel. You were on a Milken panel earlier today, and I was listening to some of the comments, not only that you made, but some of your colleagues made, about the state of the U.S. economy specifically, and how what we're seeing in the data doesn't necessarily reflect the true pain that we're seeing on the ground. How much does that matter, that there is a disconnect between some of that top-line data and maybe what's happening on Main Street?
You know, the markets have been able to perform notwithstanding what we see with inflation. And I've just cited to you what's taken place over the past 15 years. You look over the past 5 years, you're going to see commensurate data that suggests that at least the markets are performing. There's clearly some volatility to them. If you look at the VIX index, up and down, not as high as it's been during the great financial crisis, but, you know, it's up and down. We need to pay particular attention, as I think the Fed is doing, at what's taking place on Main Street, which is inflation, which is the value of the price of a carton of milk or you know, or a dozen eggs.
It's real.
That's real, so we can't ignore that. And as you think about how you manage a portfolio of assets, either corporate assets or assets that exist in the asset management world, you got to be mindful of that. You got to be mindful of the implications on valuations, if you will. And we don't see that togetherness yet, at least with some of the asset managers.
Well, that's interesting that you say that about valuations. All right, so I don't know, when you look at deal activity over the next 6 to 12 months, what are you anticipating?
You know, we have pretty good momentum today, but volatile. So our expectations that you're going to continue to see strategics. They need to grow. They need to remain competitive. And if you see a lot of the activities taking place by the strategics, it included mergers and acquisitions, stock transactions. And the cost of financing is pretty high, and I don't think the market has actually digested that from the standpoint of using cash or borrowing capacity as currency because the rates are so high. We are seeing a lot of the currency being used as stock. You can benefit from that. It's an appreciation of the value of the combination, plus the benefit from synergies.
All right, a colleague of mine, you got 20 seconds. Are you going to run for mayor again?
Oh, gosh, you went there.
I am quite confident with where I am. And, you know, my objective today is to do whatever I can to add value to Lazard and the Lazard shareholders and be a partner with Peter as we set the strategy out. And our objective is to go execute.
All right, well, that was a good way to go. And she stole my last question, which was going to be about his, no, not about being mayor, but about his involvement at Studio Museum of Harlem, chair of Studio Museum of Harlem, and the Whitney. I want to talk about arts with him, but she took it away from me. Ray McGuire, guys, president of Lazard now, and really a lifetime of experience on Wall Street. And Carol, when we talk about his perspective, and you contrast that with the perspective of some of the other folks we're going to talk to, including in the world of venture capital as well here, it'll be interesting to see how they diverge, if at all.
Yeah, absolutely. And on that, we've got a great guest coming up. Right? We can see what his view is. Victor Kosla, founder and CIO of Strategic Value Partners, see what lens he is looking through and whether or not...
Is he running for mayor?
I don't know. Maybe I'll ask. This is Bloomberg, everyone. We're live at Milken in Beverly Hills. We'll be right back. Welcome back, everybody, to our live coverage of the Milken Global Investment Conference here in Beverly Hills. I'm Carol Master alongside Romaine Bostic. Now, at the beginning of the year, our next guest said there's more pain coming for commercial real estate as the unwinding of years of easy money begins taking its toll on the sector. He is Victor Khosla, the founder and chief investment officer of distressed debt specialist Strategic Value Partners. They are an $8 billion global alternative investment firm focused on distressed and deep value opportunities. Joining us right here at Milken. How are you?
Very well, thanks. Thanks for having me.
Well, it's great to have you back. So distressed, how distressed are some of the assets that are out there?
You know, we are today, it looks like a wonderfully sedate world, right? High yield spreads, 350 basis points, technology, equity stocks are up, right?
Yeah.
So
Everything's awesome?
on the face of it, it's like ducks. Gliding
water,
yeah. It's
their legs are just like
yeah. It's, you know, so what people miss a little bit, there's $4 trillion of private equity assets invested in the ground. There's $5 trillion of people they have borrowed to make. And where we are today, high interest rates, a sluggish economy outside tech, Europe near recessionary, a wall of maturities over the next 3-4 years. So I think what you miss is, oh boy, there's a slog now to kind of work through this.
All right, so when does, and I'm looking at our live blog here on the Milken Conference, and that's one of the things that they highlighted, that you see the companies hitting that debt maturity wall. So when does it start to come undone?
It started. So, you know, when you look at what we do, if you use us as an example, right? Starting about 12 months ago, we started to speed up the pace of investing, right? So this is not like it's coming next year or something, because what happens is the maturity wall today is, there's very little in 2024. In 2025, 26, 27 is 600-700 billion a year. 600-700 billion a year, and you've got to address it early.
Right.
So the maturity wall, people are addressing it. It started.
But you've seen some of the creative tactics now that we're starting to see some funds take to make sure that we don't see those defaults.
Right.
Whether it's doing selling to another fund, just peeling off a stake here and there. I wonder, like, what do you make of that in terms of the sustainability of that strategy and protecting those companies until, in theory, we get to the other side of whatever we're going through?
And it is, you know, private equity investors are really smart, and they wiggle.
Yeah.
Right? They're wiggling. But I think when we look at that world, how big it is, our view, there's $500 billion of what we would call adventurous financing, which is required, which will be there. They'll push it off, but they'll pay a pretty price for pushing it off, right? And there's 300 billion or so we estimate, which is going to be just like, I give up.
And just to be clear, the values we're talking about too, those have been inflated because of some of these new agreements and some of these new extensions.
Yeah.
But it gets to the question though, do we need, say, like a recession or some real huge economic shock to shake this out? If not, if we don't get that shock, you think this will still play out in your favor?
You know, our view would be, we don't really expect some headline-grabbing recession. There is a chance. There is tail risk in this economy. Our base case in the United States is it's a little bit of a slog.
Yeah.
And so we're not expecting, oh my gosh, there's a credit market crash or anything like this. But just to deal with what we have, you know, for somebody like us, we've got a broad set of skills, right? We don't just buy debt at 50 cents. We have the operating skills to fix it, to take control of a company, to manage it better. For somebody, when we buy assets, we own operating platforms to own the asset and to fix it. For somebody like us, it's really attractive.
Would you want to own commercial real estate assets though right now?
You know, we've been looking. The most interesting investment we probably made in commercial real estate, one of the two best investments we've ever made in a firm was in commercial real estate 2-3 years ago, right? But what I would tell you is last 10 months, we are seeing that slide. We are in the process of making our first ones, but boy, you've got to be careful.
Yeah.
You know, when you look at these office properties, there's $2 trillion of office mortgage debt in the US and Europe. But you don't know, is the occupancy, hey, it's 40%, how much money does it take?
Yeah.
You've got a problem. You've got to be careful.
You got to do your homework, that's for sure.
All right, Victor, we're going to have to
Thank
leave it
you.
there. Victor Khosla over at SVB. And it gets to this idea,
Not
too,
bad.
of where those opportunities are. We talk about both sides of the equation, the folks that might be forced to sell, but more importantly, the folks who are there to buy.
When talking with Victor or someone like him, you know, just a reminder, two sides of the equation. Like there is something, a distressed asset that to somebody, that's a good opportunity, but you've got to really know that asset that you're buying.
Yeah, I think I just said that, so that was a good point.
Oh, did you?
Yeah. Carol Masser and Romaine Bostic here live at the Milken Stage. Let's talk us back to New York right now.
You think I listened
where
to
Tim
him?
Senovic is standing by. Tim, I got Carol here.
It sounds great coming from either one of you or both of you. It just doesn't matter. Hey, we're still getting earnings crossing. We're in the midst of earnings season, certainly. I do want to check in on shares of Rivian because they're bouncing around in the after hours right now. They were lower, but now higher by, let's go ahead and call that 1.4%. The company did post a wider than expected adjusted loss of $1.24. Estimates were for $1.15. Revenue did come in above estimates at $1.2 billion versus estimates of $1.18 billion. They delivered 13,588 vehicles, surpassing estimates of just over 12,000. And also for the year forecast, they see CapEx to $1.2 billion. Estimates were for $1.66 billion. So a pullback in CapEx there. Now seeing shares move lower, higher, unchanged. Investors trying to make up their mind ahead of this earnings call. Reddit shares, that direction is certainly clear, and that direction is higher, up 17%. The company reported quarterly sales that topped analyst estimates. Remember, its first earnings report as a publicly traded company. Revenue increased 48% to $243 million for the most recent quarter, above the estimate compiled by Bloomberg of $212 million. The company sees second quarter revenue between $240 to $255 million, again, surpassing estimates of $228 million. First quarter daily active users came in above estimates at 82.7 million. Romaine, back to you out there in Beverly Hills at the Beverly Hilton.
All right, guys, we're back here at the Milken Stage here at the Beverly Hilton. Let's talk about Capital Group. It is homegrown right here in Los Angeles, and it's probably best known for its prowess in picking stocks. But as of late, it's been putting up some of the best results among actively run bond funds. As of last year, the manager of $2.5 trillion in assets had amassed almost $500 billion in fixed income holdings. That's more than double what they were less than a decade ago. It's elbowed its way past fixed income rivals who are still enduring a siege from cheaper index funds and rising interest rates. Here to talk about the state of the market is Mike Gitlin. He is the president and chief executive officer over at Capital Group. Great to have you here, Mike.
Good to see you again, Romaine.
Let's start talking about the bond side of the equation. We'll get to stocks in a second here. And talk about the evolution of it, because the growth there has really picked up in recent years. What was behind that?
What was behind that really was investment results. Our team tried to generate a predictable pattern of returns. We have a really strong team. They were able to do that over 1, 3, 5, 10 years, and clients appreciated that journey. You know, clients in the bond market, they don't want a wild ride, and the team was able to generate those kinds of outcomes, and the assets followed.
You were working, your team was working with financial advisors to push this as well. You had new products, ETF products too, right? If I'm correct?
We launched a bunch of new investment services, mutual funds, ETFs, collective investment trusts, whatever the vehicle of choice for the client was, institutional separate accounts. But the real difference was beating benchmarks after fees. If you look over 5 and 10-year periods, 100% of our bond strategies beat the benchmarks net of fees. That's a good story to tell for our clients.
The fixed income environment today, is it like a once-in-a-generation event in your view?
I don't know if it's a once-in-a-generation event. There's a real opportunity, though. If you look at the bond markets right now, you can generate anywhere between 5 to 7% yield without taking a tremendous amount of either interest rate risk or credit risk. It's a heck of a lot different than it was 5 and 10 years ago when we had zero interest rate policy. So we see a lot of interest in the bond markets. Even year to date, we have about $1 billion of net new flows per week into our strategies. I actually think that's going to accelerate once we get the first Fed cut and people can get real income. In the previous decade, the income wasn't in fixed income.
Yeah.
Now it is again, and there's a lot of opportunity.
Did you think we're going to get that first Fed cut, though, soon, this year?
Look, I think we're looking for the inflection point, not the month. I think later this year we'll get our first cut.
Okay.
And I think that's where you have to lean in and start being comfortable owning duration again in bond strategies. What hurt clients in 2022 was owning duration because rates went up so fast.
Yeah.
It works the other way around too. So as rates get cut, clients are going to benefit not just from income, but from total return by owning duration. So as we get that first rate cut, there's going to be a lot of opportunity in bonds. And also cash as an instrument, cash is going to decay in value once you start getting rate cuts. That's just around the corner.
How much are you still seeing in cash right now?
So right now, globally, there's literally $10 trillion in money funds. The baseline for that is about $3 trillion. So there's about $7 trillion of excess cash sitting on the sidelines. That cash will come in the bond market before it runs into growth equities. So that's what we're already starting to see, that kind of flow. And again, I think that will accelerate as you get to the end of this year and into 25.
Well, explain that, why you think that. Why it will flow more into fixed income rather than into growth equities.
You know, if you've been hanging on to cash and you've been comfortable getting 5%, you don't necessarily leap directly from cash into more risky assets. You tend to take a little stopover in fixed income where you're generating better return than cash, but on a risk-adjusted basis in a little bit more calmer environment. So I think it will stop there. Ultimately, we'll see equity flows, and we're beginning to see some of those as well. But I think you'll see the first stop into the bond market.
But with all that money that's sitting in money market accounts, cash accounts right now, that level that you cited, 10 trillion globally, whatever it is here in the U.S., it's been at that level now for a while. So, I mean, it's got to be more than just a Fed cut that sort of shakes that up and gets that money out.
You know, it's market volatility. It's concern about elections. It's concern about geopolitics. All of those things, when you're getting paid 5%, may convince you to sit on the sideline.
Right.
Why not? And that's what some people are saying. The reality, though, is once you start getting these Fed cuts, that 5.25 cash yield goes to 4.75 and 4.50 and 4.25, and at the same time, you have this opportunity to generate better income and total return in active bonds.
One last question, just quickly. You said money is starting to go into the equity side, all that cash that's sitting on the sidelines. Where in equity is it going?
You know, in equities, we're going to see a broadening beyond a very narrow benchmark in the S&P 500. You're going to see a broadening into small and mid caps, into dividends, into international stocks where MSCI X the U.S. over the last 15 years has done half as well as the S&P 500. A lot of opportunities outside the U.S. So I think you'll see that spread around in a lot of different areas.
So when we talk to you a year from now, we're going to be talking about the full-on embrace here.
We got the full-on,
everything.
The equity universe?
Equities and long duration, everything.
Out of cash, too much money in cash.
Yeah, all right. Mike, we got to leave it there. Great to talk to you. Thanks for taking time for us. Mike Gitlin, who leads the Capital Group. And I always like to talk to folks, you know, these are like the homegrown companies too here in LA. So I'm always into that stuff as well.
And it's kind of fascinating, all of the kind of alt investment strategies, private credit that we've talking to, just kind of really get a good view in terms of what's going on in fixed income and also a little bit in the equity side.
Absolutely. We got a lot more to talk about. We're going to take a big pivot coming up. And I know this is a topic near and dear to your heart.
Yeah, Dr. Ali Rezai, he's director of the Rockefeller Neuroscience Institute. It's interesting what's going on in healthcare. We've talked earlier, conversations, the innovation, how it could change things dramatically going forward. That conversation with Romaine and myself is coming up right here from Milken. You are listening and watching Bloomberg. Welcome back to our live coverage of the Milken Global Investment Conference. I'm Carol Massar alongside Romaine Bostick. Well, the annual Milken Global Conference is dominated by leaders in finance. You know that. Another category that always factors into the speakers and conversations is health and wellness. Our next guest here at Milken was featured recently in a 60 Minutes piece on the work he's doing at the Rockefeller Institute at West Virginia University. We welcome neurosurgeon Dr. Ali Rezai. He is the Associate Dean of Neuroscience at West Virginia University. He's also Executive Chair and Director of the Rockefeller Neuroscience Institute. So nice to have you here with Romaine and myself. I have to say, when we were planning for Milken and your name came up, I'm like, yes, yes. 60 Minutes did recently feature some of the work you've been doing, but you've been studying the brain, neuroscience, neurology for a long time, many decades. How much have we learned about the brain and its connection to maybe future healthcare treatments? How much more do we have to learn?
So neurological conditions are growing as the population is aging, and we have more people with Alzheimer's disease, more addiction, people with ALS, people with different types of dementias. And we need to find solutions, and we need to work together between industry, public, private sector. In the same way we came up with the solution for COVID, with the COVID vaccine, we need to build teams together that are accelerating the pace of discovery, because Alzheimer's is not going away, addiction is not going away, and we need to find solutions quickly.
Well, the pharmaceutical industry is really trying to find solutions for Alzheimer's. You have figured out something, and also with addiction, and it's using, I'm going to be very basic, but sonograms. So talk to us a little bit about the work you are doing.
So we're using ultrasound technology, and this has been universally there when you look at a baby in a womb.
Ultrasound, I should say, yeah.
Exactly. So it's one ultrasound looks at a baby in a womb, or for heart doing echocardiography. In this case, we have 1,000 ultrasound probes that we're delivering the energy that goes through your hair, through your scalp, to different parts of the brain, and converging in different parts to stop the tremor from Parkinson's, to open the blood-brain barrier so more drugs can get into the problem area, or to reset parts of the brain involved with substance use disorder and addiction. So the application...
Which hasn't been happening before with Alzheimer's, right? Because the drugs, they don't penetrate quickly enough.
Exactly. So we have good pharmaceuticals industries doing a great job in accelerating discovery, so drugs are able to go in, but 99% of the drugs have difficulty crossing a blood-brain barrier, which is in your brain's blood vessels, and that's why you have to give higher doses, more frequency, and long-term drugs. But what if now we can open the blood-brain barrier non-invasively with an outpatient procedure temporarily, to allow much more drugs to get into the area where the problem is. And that can potentially help really accelerate and make drugs even more effective and safer.
How close are we to that, to seeing that actually deployed?
We and other groups have demonstrated that, where we can non-invasively, for example, somebody with Alzheimer's, they have these protein buildup in the brain. So we can open the blood-brain barrier in the areas with beta amyloid plaques and then deliver the antibody. So now the antibody can get in faster because the barrier is open, and then do its job. So we found that in initial study that we can increase the removal of these plaques by 53% more as compared to antibody alone.
Is that going to be effective on people who are in advanced stages of Alzheimer's, or is this only going to work on people who are maybe at the early stages?
Right now, studies for very early stage, but this has potential for Parkinson's, for people with frontotemporal dementias, ALS, and many other conditions. So we think this is important for the pharmaceutical industry and partnership to now provide a new way where we can deliver the drugs to the brain, to the problem area exactly where it is, deliver the payload, and then it closes, so the drugs can become more safe and more effective potentially.
Dr. Rezai, Alzheimer's is one thing, addiction is another one, and we probably all know someone who's had to deal with addiction on some level. Tell us about the same kind of treatment, similar, or I should say, that's also being effective when it comes to addiction.
Yes, so the same technology is being used. There's a part of your brain, deep in the brain, that is your addiction center, reward center. So this country is having a big problem with substance use disorders, fentanyl, heroin, cocaine, meth, and there are more than 40 million people with substance use disorders. So the solutions can be effective, but they're not good enough. Last year, sadly, 110,000 people died from overdoses, and it's only getting worse. So we need to explore new technologies and partnership with science and industry to help people with addiction. And the work that we did, we're able to show initially that we can deliver the ultrasound beam and reset the brain, the craving parts of the brain, so the cravings are dramatically reduced, and people are now able to deal with addiction and the cravings better. and are not taking as much drugs. So we're very excited about this opportunity.
I do think about here at Milken, right? It's all about capital, lots of money here, investing, going to different places, capital flows and medicine and treatments and discovery.
Yes.
Tell us what you are seeing on that front and what more you would like to see.
So what I discussed with you about Alzheimer's work and the addiction, it was all developed by philanthropy and foundations giving us the seed capital. And that seed capital raises all the other sectors coming in. And it's only with combining philanthropy with science and technical expertise, industry, government all together. Once they come together, magic can happen. And we've already shown that for COVID, for example, with the COVID vaccine. And this needs to also happen for neurological conditions because many of them we don't have a solution for. Population is getting older, and we have people that we need to help. So we should be very impatient and try to collaborate together to help people find cures and also find ways to improve the quality of life.
With the money that's being raised, particularly the money that's not coming from, say, philanthropic organizations here, obviously there's a demand of return at some point here. What exactly are those folks asking for?
So once we do the initial work, this is all technology that leads to new innovations that can build new businesses. Mm-hmm. So you can find new businesses. There are dozens of companies making ultrasound systems. Combination therapy will enable the pharmaceutical industry to have better solutions to deliver the drug to the exact area. So you may not need years of treatment, you may need just a few treatments. So this actually will accelerate discovery and innovation and will lead to more technology commercialization opportunities.
I have to ask you, you know, as someone who's had to watch firsthand on a couple of occasions, people dealing with dementia, Parkinson's, and the very slow process of watching that unfold, we've seen sort of these potential breakthroughs that promise that this would be the last generation of folks to really suffer from this. And we've seen that come up short. How do we make sure that we don't run into that again?
Right now, we're having some good solutions that helping people improve their quality of life. We need to search for the cure, but only, in my opinion, by bringing teams together with a passion and purpose and an impatience and a sense of urgency, because you're right, Alzheimer's is not going away, Parkinson's is not going away. So we need to bring in more capital from foundations, from philanthropy. We need more collaboration with the industry and the private sector. We need government collaboration. And fundamentally, it's about patient suffering. We need patient advocacy groups. Once that all comes together, we can provide new solutions. We may not have the answer, but we're going to give it our best shot and help quality of life and seek for cures.
How do you think about, and kind of going back to where I started, I think there's so much we've learned about the brain, so much we still are learning. I mean, when you think about innovation in healthcare, what will be kind of the next frontier? Here we are talking about the diet drugs that seem to be fixing everything that ails us. But how do you think about it, the smart frontier going forward?
I think for the brain, we need to understand diagnostics, detect Alzheimer's earlier, because Alzheimer's and Parkinson's, for 20 years, your brain is degenerating. You're not aware of it. But what if you can detect it 10 years before you first have the first manifestation of it, or to be able to treat people better than ever before? So number one, detect it earlier, change lifestyles or participate in clinical trials, and have new solutions. This technology like the ultrasound. It's used for looking at a baby or the heart, but now it's used to treat brain conditions. So embrace it, partner, and then we can accelerate the pace of discovery and do rapid cycle innovation. So I think the future is bright, but we need more partnership and collaboration here.
All right. Well, listen, so delighted to get some time with you. Really appreciate it. Dr. Ali Razai, he's, of course, at the Rockefeller Neuroscience Institute. He's the director of that at WVU. Interesting, right?
Yeah, and I think needless to say, everybody is rooting for him, even if they don't know
Totally.
him. This is something that I think has plagued so many families, and everyone really is holding out hope that we finally see that. And I like what he said, too. It's not just about what the scientists are doing. You need government buy-in, you need the philanthropic organizations, and you need the private sector. And that helps push this along. You saw what we were able to do with COVID.
Well, that's what I was thinking. During the pandemic, what we were able to do so quickly, but everybody came together. And this is what's kind of interesting about Milken. We're going to be back tomorrow. We've got more interviews, but it really is this cross-section of, yes, finance, but it's healthcare, it's wellness, it's everything that's kind of going on in society, and how do we find the money that's needed to find the right solutions going forward?
Yeah, well, maybe we'll hear some of that tomorrow. We have a lot of big guests. Carlicia Graham, who I'm really interested in talking to, and New Media Ventures, and Walsh over at Guggenheim. She's going to have a lot to say as well.
Yeah, exactly. And CEO Al Rabel over at Kane Anderson, we're going to also talk with him, and New Media Ventures President Carlicia Graham. So we've got more conversations, cross-sections of our economy. economy in our world at Bloomberg. But from Beverly Hills, that'll do it for me and Romaine Bostick. Have a good evening, everybody. And this is Bloomberg.